Now, if we go over kind of why the market's taking, we have our volatility index here, the VIX. So if I look at this on a 5-year chart, I drew these lines previously to kind of just help guide my eyes. But you look here back in February or March of 2020, you'll see this was the pandemic. There's a huge spike in volatility. This is when the market crashed. So if I look at the SPY, this is right here. This is March of 2020. There's a big drop and then followed by a big recovery. So in a previous video, I talked about this where, the market came down due to the volatility, and then in the same year, it hit a V bottom and then started going up. So it was really crazy to see. There's a lot of the money printing, the government, the Treasury, the Federal Reserve, everything was changing, and there's a big spike up in stock prices. But when we look at the volatility, the VIX, right now, you'll see it kind of coming down. This is back in 2020, going into 2021, right? So volatility was lowering, and then volatility started rising in 21, 22, and the volatility started lowering in 22 to 23, and now here we are 23 and going 24, and we have another volatility spike. So if we look at that 1-year chart, I'm just going to extend my lines a little further just to show that clean break. And I have these horizontal lines on because typically, if I hit this all button, this volatility index goes back to about the 90s, early 90s looks like, and then it continues on. And it doesn't go much below 10. So you see this lower line here. The volatility doesn't go much below 10. Right? That's kind of like the low end of volatility. So this isn't an index chart that goes to 0. It's just when there's not a lot of trading activity, the volatility goes lower. And the average volatility is somewhere between 10 and 20. You see a lot of like low volatility here, then you see these huge spikes that come up once it gets above 20. These huge spikes, right? So I'm always looking for that. Like whenever it gets above 20, these huge spikes that come up, and this is a good example. So this is, let's look at it 1 month. So this was Thursdays and Fridays volatility. This is August 1st, August 2nd. This smashed through the 20 VIX. It just came up here. And this is why in correlation we saw this crash. Now we're looking at the S&P 500. Look at this crash that happened. So at the same time the VIX was spiking up right here, the stock market, the S&P 500 was crashing down. And this is why all the numbers were 1 to 2% swings. It's very volatile and weak.